Trump wants 1% interest rates, and it's not just campaign talk. This push is gaining traction. At first glance, it sounds great. Lower mortgage rates, cheaper credit cards, easier loans. But wait, it's not that simple. A rate that low usually screams crisis. Not growth, not stability. So why now? Why slash rates when the economy isn't crashing? Let's talk about what that 1% would really mean. For your savings, your debt, even your grocery bill. Because no matter where you are in life, this shift could hit your finances in ways you haven't thought about. Right now, the Fed's rate is just above 4%. That's high enough to cool inflation, but low enough to avoid recession. A careful middle ground. But Trump, he wants to toss that strategy and go straight to rock bottom. Why would a businessman turned president want rates that low during a normal economy? The answer's simple: debt. And not just yours, America's. His massive spending bill, tax cuts, defense, infrastructure, and more, needs fuel. And low rates make borrowing that fuel a lot cheaper. Imagine refinancing a $36 trillion national loan from 4% to 1%. That's a no-brainer, on paper. But cheap borrowing leads to more borrowing. Just like when credit card rates drop and you're tempted to swipe more. Over time, the costs stack up, and they don't go away. And don't forget the global investors. If they think the Fed is bowing to political pressure instead of economic data, confidence drops. Nervous investors demand higher returns. That means long-term borrowing actually gets more expensive. Let's rewind for a second. The last time we saw 1% rates. After 9/11, the 2008 crash, and COVID. Each time, we were in full-blown crisis mode. But today, unemployment's under 4%, inflation's stable, growth is steady. Cutting rates that low right now would be like sending out a distress signal during calm weather. And markets always hear that signal. Think this doesn't affect you? Say you're house hunting. You expect lower Fed rates to mean lower mortgage rates, right? Not always. Mortgage rates follow long-term yields. If investors panic, those go up, even if the Fed's slashing short-term rates. So you might still be stuck with a high mortgage and rising food prices. That's a bad combo. If you're retired, here's where it gets personal. Low interest rates equals low returns. Your savings account, CDs, bonds, they all start paying you less. Suddenly your fixed income isn't so fixed. And if you're holding annuities or long-term bonds, their payouts may not keep up with inflation. Your money stays safe but quietly loses value. What about working families? Sure, credit card, student loan, and car payments might drop, but maybe not for long. If inflation creeps back up, lenders could raise rates anyway. So those savings could vanish fast. And here's the big picture: this is about trust. The world trusts the US to run its economy responsibly. But use emergency tools when there's no emergency. That trust can crack, slowly at first, then suddenly. We've seen it before in other countries. When trust falls apart, interest rates spike, inflation surges, currencies tumble. The US isn't there yet. But this kind of move, it's how the slide begins. So where does this leave us? It's complicated. Lower rates could boost spending in the short term. But they also risk inflation, weaken savings, and rattle investor confidence. It's a dangerous gamble. And most economists agree, 1% doesn't match the moment. It's like cutting your brakes just because you're late to work. So, what can you do? Start by checking where your money sits. If you're saving, don't rely just on interest. If you're investing, stay flexible, assume nothing. And if you've got debt, keep an eye on rate trends. A small drop could be your chance to refinance before things shift again. Because this isn't just about politics or charts. It's about real life. Your plans. Your stability, your future. As we wait to see what the Fed does, and whether Trump gets his 1%, ask yourself, is this smart policy, or are we playing with fire? Drop your thoughts in the comments. Would a 1% rate help you, or hurt the system? And don't forget, like, share, and subscribe to the Untold Compass. We break down the moves that matter, so you don't get blindsided.